How to use covered calls for extra income. Here's the thing, if you own some stock or if you trade with shares of some stock, options could give you additional income and additional hedge for these trading strategies. And one of these strategies is covered calls. Now, this strategy might be slightly complicated if you are a complete beginner, but that's why you are watching this video, to have good, understandable explanation how this approach works. So let's start. First things first, there are two ways of options, call options and put options. In very simple terms, call options gives you right to buy a specific stock or security, and put options gives you opportunity to sell specific stock or security. And you could be buyers of these options and sellers of these options. Now, if you are a buyer, you are simply putting down money for that premium, and if that option is worthless, you have lost some of that premium. But if you are a seller, you are collecting this premium and you have duty to exercise that option by the terms that were dictated by the starting of this option. So in one side there is limited downside risk and unlimited upside risk, and with selling options you have theoretically limited profit and unlimited losses if something goes off your way. But here's the thing, if you combine selling options with holding that security, you are mitigating the risk. Well, let me give you a practical example. For instance, you could own stock of Nvidia. For instance, you could be buying it at $115, and simultaneously you could actually be selling call option on this specific Nvidia stock. So that would mean at one point you are trying to bet that price will rise because you bought it for 115, as it is with now our theoretical example. But if, for instance, you have sold call option at $155, you are receiving premium for that call option. So that means if prices fluctuate between $115 and $155, that means you are getting premium for that worth of money. So you are in the money because your initial stock purchase isn't profit, because it's higher than it was at the time when you were buying it, but option is not already exercised. So that means you are collecting premium for that option. If market volatility is relatively low, you are constantly making money by selling these kinds of options. And actually this is the way how covered calls works most of the time, because that's the strategy when volatility is quite low and you are making rather steady gains, because you bought it stock at a cheaper price, you are in the profit, but not in the very large profit. So that means you are effectively going and receiving those nice premiums. But what happens if prices hit that level where you have to sell that option? Well, then I suggest you have to convert that option into that stock, and actually you have to liquidate this position. Second opportunity how you could actually benefit from it. It gives you a precise exit point of your stock. And if it's used correctly, yes, it works very good, because it gives you additional benefit, because that premium which you receive by selling options actually is kind of price increase for your initial stock purchase. So this is the second cool thing about covered calls. But now let's explore the third possibility. If stock goes below 150, that means, of course, you are suffering a loss because stock is lower than you initially thought it would, and you're actually selling this option. So that means selling that option slightly mitigates losses of your initial sell. That's how covered call could actually benefit for you. Yes, it might be really tricky and really difficult to do it, but as you see, there are three clear advantages over simply owning the stock. Firstly, that means you are making money if price has really low volatility and it's actually not going that high away and moves in narrow range. That's one thing. So you are holding your stock in profit, collecting dividends and collecting premiums for covered calls. Secondly, if you have specific exit price in mind, you could actually use it and sell call options at that price, and you will have this covered call strategy, and you have perfect way how to actually exit your stock long position. Now, of course, if prices will go way higher, you might miss your profit opportunity, but still you will have very, very specific place where you exit your trades and you'll be off of a very worries. Thirdly, of course, it could mitigate downside risk as well, because if you hold stock and it's at loss, and simultaneously if you have selling call options, you will receive that premium and that will slightly mitigate the risk. So these are three options how you could actually trade with covered calls. But here's the thing, in order for you to do that, you have to know mathematics of options, because if you do this wrong, if you don't exercise that option, if you have to exercise it, if prices go higher, you could be in large losses. And if you don't know how to actually buy them and sell them, well, it's difficult for you to trade. But luckily for you, here's the thing. You could join my Telegram channel and you would see how actually options trading is done, how different kinds of trading analysis is done, and you could actually get free trading signals for all of the stocks, options, and various types of futures trading strategies. So if this is something for you, join my free Telegram channel. Now, before we end, there is one thing I also want to address. If you are trading options, do not try to time the market and try to pick best times where you could actually buy it or sell it, because it goes against options trading strategies at all, because options is pure probabilities game. It's not market forecasting game. It relies on clear math and probabilities. So it's more game of how you are actually pricing your stock investments versus your options rather than what will happen in the next 6 months. Because if you are trying to figure out what will happen in the next 6 months, you'll be far better off by simply in long-term investing or in trading. With options, game matters in the fact how high is your options strike price with comparing your stock entry price. What are the dates where you are liquidating that options, or to be precise, at what dates these options and how actually these options are priced. Because if you would see any stock and options on this stock, you would see that by changing strike price or the time when options are actually expiring, the price of these options changes significantly. And precisely these levels, how to actually find them, they will actually give you largest impact of your potential profit or loss. Because the cheaper options are, theoretically, yes, you are options seller and you will get premiums. So it depends how much you actually want to make of those premiums. You could have options which are very far from market and with very long expiry dates. Then you will have one premium. But if the options are very close to the money with very narrow or very close expiry dates, then options will have completely different premiums. So this is the question which actually will give you most of additional money. And you should spend your time on those option pricing strategies rather than market forecasts. Yes, it might go completely differently if you haven't traded options before, but remember, options are pure mathematics and probabilities games. And if you want to forecast markets, do that with simpler assets. So this was my suggestion before we end this video. And yes, it might be somewhat complicated for beginners, but rest assured, if you watch my Telegram channel, if you watch other my videos of investing and trading, you'll have way better experience of markets. And if you understand markets and probabilities quite good, then options comes really easy. But if you're not trying to learn something new, then it might be hard, because you don't have to know all the complicated math which are involved in options. All you have to have is basic sense of probabilities and simple logic. So think in probabilities. Do not try to forecast markets. And if you think in these categories, then strategies like covered calls will be really simple for you. So thanks for watching, and let's meet later.